Well, good afternoon. I'm John Sangenberger, and I head the Alumni Relations Office at the Tepper School. And we're so glad to welcome you to our Alumni Investment Outlook 2022 panel. It's a very timely one, as the economic outlook is in the front pages of all the news, not only in the US, but across the globe, especially as we continue to be impacted by the Omicron variant. But before I begin our discussion, I want to give you a couple of announcements. First, I want to let you know that we have an upcoming webinar on February 2nd on the challenges and strategies for supply chains in 2022. Very hot issue for us as well. We've got an impressive lineup of alumni leaders in the field representing some leading companies in the US with some international perspective as well. So hope you'll mark your calendars for that as well. We also want to keep you to mark your calendars for our upcoming reunion. This year, we're going to have 2 reunion weekends. In addition to Carnegie Mellon's Carnival and reunion weekend, we're going to have 2 Tepper specific weekends, one for our 1-year reunion celebrants and also for our others who from the classes of 1, 2, 6, and 7. So we're looking forward to all of you for that. We've got great committees working on those reunions right now. But let me go on and now introduce our speakers for today. First, our faculty host and moderator is Professor Lars Alexander Kuehn. He received his undergraduate degrees from Freie Universität in Berlin and his PhD in finance from the University of British Columbia. He joined us in 2008 and was named associate professor in 2014. Professor Kuehn teaches courses in finance and corporate finance to undergraduate, MBA, and PhD students. He received the Tepper Undergraduate Teaching Award in 2013 and the George Leavenbach Excellence in Teaching Award for the MBA program in 2021. So he's our most recent recipient. He also is the faculty coordinator of our Business Analytics MBA track, with his research focusing on capital markets and valuation models for debt and equity. So glad to have you with us, Professor. Now let me briefly introduce our 4 alumni panelists. They each have impressive backgrounds, and I can't adequately cover all of that, but I'll give you some brief highlights for it. Jennifer DeSisto is Chief Investment Officer and Portfolio Manager at Anchor Capital Advisors in Boston. She received her undergraduate degree here in industrial management and then went on for her MBA from the MIT Sloan School of Business. As CIO, Jen oversees the investment team of portfolio managers and analysts and leads their all-cap and balanced value portfolios, which are 2 of their legacy strategies. She began her career at Citi in New York before joining Bank Boston, later acquired by Fleet, and then Bank of America. Her roles were leading the US and global equity products at Battery March Financial Management, and then as portfolio manager and head of research at Fiduciary Trust Company. She joined Anchor Capital Advisors in 2016. Glad to have you with us, Jen. Linda Diesel is joining us as Senior Vice President and Senior Strategist for Federated Hermes, based here in Pittsburgh. She received her undergraduate degree at the Wharton School at the University of Pennsylvania, practiced as a certified public accountant prior to earning her MSIA at Carnegie Mellon University. She started out with Arthur Young and Company before joining Westinghouse Credit as an analyst and high-yield bond portfolio manager. She joined Federated in 1991 and is part of the team responsible for formulating Federated's views on various equity market conditions and the firm's positioning strategy. She's responsible for articulating their strategy, process, positioning, and performance of their portfolios. She publishes a weekly update online, so check out her latest article on her website on the key risk, where she discusses expectations for inflation. Mike Maglio is a executive director and banker at JP Morgan Private Bank. He received his BA in mathematics and political science from the University of Vermont, and then his JD from the Catholic University of America before going on to the Tepper School for his MSIA. He's advised private clients since 1995 and served as a senior family office executive in 2 prominent family offices. Before joining JP Morgan in 2020, he was an investment director at PNC Wealth Management and senior director and team leader of the ultra high net worth team at BNY Mellon's Wealth Management. And prior to attending CMU and Tepper, he started his career in Washington as an international trade lawyer. So great to have him with us. And finally, last but not least, Rob Sechin, co-founder and managing director partner at New Edge Wealth, where he specializes in advising clients on asset allocation, portfolio construction, and opportunistic investing. He holds dual degrees from the Tepper School with his undergraduate degree in industrial management and economics and his MBA in finance and economics. Prior to co-founding New Edge Wealth, Rob was a managing director at UBS, where he served as the UBS Financial Advisory Council lead of Intellectual Capital Subcommittee, which helped guide the firm's tactical investment processes. He's worked in financial services for over 25 years, holding prior positions as managing director at Lehman Brothers and executive director at Morgan Stanley. Rob is a regular on CNBC. Some of you may have already seen him. He's also appeared in other business shows. He's been recognized by both Barron's and Forbes as a top 100 financial advisor, and his top 2022 stock picks were just announced on CNBC on January 10th, so check that out on YouTube. And he's also been a great alum, hosted our Tepper summer welcome reception at his home in New Canaan, Connecticut. So wonderful panelists today. Let me hand it over now to Professor Kuehn to begin our discussion with our four esteemed alumni panelists. Thank you.
Thank you, John. Thanks for having me. I hope it's going to be like a nice discussion, and also thanks for the panelists for being here, for spending the next kind of an hour with us and discussing kind of the financial markets. I'd like to show you just a few slides, which are kind of, people have seen that probably from my teaching. So I also like to do a poll. So maybe Brian, could you please start the poll at the same time as I'm talking about, so I'm showing my slides. Okay, so I just like to give like a quick review of what kind of happened in financial markets in the last year, and also give like a few opinions about it as well. So that's the outlook for 22. So here, I just want to show the equity market, the bond market, and a little bit about the labor market and inflation. So here I'm plotting the data. So this is kind of daily data for kind of 3 different asset classes, 2 for the equity market and 1 for the bond market. So AGG, that's the aggregate bond market, has been pretty dismal to 2021, was kind of heading, I think, negative, was definitely ending negative territory for the year. And then you have the blue and the purple line. The blue line is the blue line is NASDAQ, that's the triple Q ETF, and the purple line is the S&P 500. And what you see is they definitely both did stellar last year. They kind of closed up to 30%. They ended up both kind of 30% in the plus for last year, which is obviously a fantastic performance last year. What's interesting here is that that the S&P kind of ended up above the technology index. And that's kind of interesting because over the last few years, technology has been outperforming the market, but last year that wasn't the case.
Excuse me, so, Professor Kuehn, we're not seeing your slides.
You're not seeing my slides? What is
that? There we go. We see it now. Yep.
Oh, but didn't before?
No, we saw the panelist questions before.
Oh, sorry. Yeah, that was the wrong screen. Oh, my fault. Okay.
You tipped your hand, Professor.
Typically, it doesn't happen. I have 2 screens, and I showed you the wrong screen. I'm sorry for the mistake. So here's now the right one. Typically, it doesn't happen during teaching, but here we go. Has to happen once now. But thanks for pointing out. So here, this is now the equity market slide. Blue and purple line up 30%. Bond market kind of heading down there. That's the red line. Next slide is about kind of just dissecting a little bit the equity market. That's momentum, the momentum portfolio of winning firms, quality firms, that's QOL, size are the small firms, and VLL, that's the value portfolio. And last year, what you see is kind of value has done the best. And that's kind of surprising because value has done pretty poorly again. Technology has been dominating value for the last 3 years. But last year, value has done a great year. It was a great year for value. And especially here at the end, even for the last few weeks, value has been doing great. And there's a shift out of technology, which has benefited mainly because of COVID, the working from home kind of environment. And then for the bond market, here I'm showing you the 1-year treasury rate and also inflation. So the 1-year treasury rate was definitely close to 0 for the last year. Before that, we had a small ramp up to 2%. Financial crisis was much higher. But the problem right now is we're heading into a high inflation regime. So inflation at the end of the year annualized was 5%. And that's a little scary because typically we target around 2%. At least the Fed is trying to target 2% inflation. Now we're heading into 5%. And that's definitely going to signal that there will be rate increases coming next year. And the question obviously is, well, what does that mean for the bond and for the equity market? So this another perspective is to look at the equity market, at the labor market, and you see the same kind of tightening of the labor market unemployment rate during COVID was kind of spiking at 14%, but now we're heading into 4% unemployment rate. So that means the labor market is very tight. Lots of firms are looking for workers. The blue line is the quit rate, and that's often a number of people don't look at. That's the voluntary quit rate of workers, and that has been rising. That means people are voluntarily quitting their job because they're knowing there are better opportunities out there for them. So again, labor market signals a hot economy, and there's probably going to be rate increases coming from the Fed next year, and that's going to be one of my questions for the panelists. What's going to happen in the market? Okay, so let me now come to the poll. So I have, let's do the first question. So what do you expect for the, what's going to happen for the US equity market for 2022? So next year, last year we're at 30%. Here we have a roughly 150 people answering the question. So they expect 5% for next year. So it's going to be much worse performance than this year. Still, people, I guess, are still optimistic. And that means plus 5% is the mode. Some people are more pessimistic, and nobody expects high returns for next year, which is probably not the, probably pretty representative outcome here. For 2022, I expect the US bond market will go down by 10%, down by 5%, be flat like this year, or up by 5 or 10%. And the participants believe most likely outcome next year will be up by plus 5%. That's the mode at 32%. Some people are pessimistic. That also makes sense, I guess, because like rising interest rates, I mean, that's going to depress bond prices down by 10%. So here we see definitely much wider dispersion. Let's do the third question, and then I think that's enough then. And the last question, the third question is about interest rate targets for next year. So at the end of 22, the federal funds rate will be at 0.51, 1.5, or 2%. So the Federal Reserve already announced they're going to do 3 increases, and mode is at 1%, 40%. Some people even think 1.5 or 2%, but obviously nobody thinks we're going to be stuck at 0. Thank you. Thanks for the polls. I think that's enough polling. Let me now go over to my first question for the panelists. And the first question I'd like to ask Linda. What is your investment outlook for 22? How will inflation, COVID, the supply chain problems, the political uncertainty impact the US economy? Linda, what do you think?
Well, hello, and thank you very much, Professor. And John in particular, thank you for allowing me to come and talk with the group today. We at Federated Hermes had an expectation for 4,800 S&P to finish last year, and we were pretty much right on target. We're bullish again this year for a 5,300 target on the S&P 500. That would represent a 10% return, which we think would dovetail with 10% earnings growth. So the price that we pay for each dollar of earnings, the PE multiple, we think will be about flat. It should be a more volatile year. And the idea of volatility is quite consensus, but there are a lot of catalysts, as you suggested, for why we might have volatility. But as we go through the year and have some volatility, which we have started out the year with, obviously, I hope people will remember that an average year correction of 10% once or even twice is normal. Last year was a very abnormal year where you only had a 1.5% correction. So if we are, as investors, are going to really worry about volatility, it would be because we think a recession is on the horizon, and we don't see that at all for this year. But as you mentioned in your question, Professor, there are many catalysts for volatility, and we need them to go in the right direction. And the first one has been for the last 2 years, always has to be how this virus carries on. And of course, we all know that now we're in the midst of Omicron. It's very contagious, and it's more like a cold, which is good news. It's racing through areas of the world quickly. And as much as people want to concern themselves with maybe there'll be a new variant, you know, we can worry ourselves about this, in my opinion, as long as we want to, but we look at cases and worrying, and we look at CEOs' expectations, and they don't seem to be worried about it. So as a stock market investor, I'm not particularly worried about that. What's to worry about is inflation and the Fed's response to it. As we all know, the Fed said it was transitory, this inflation that 2 whole generations have never seen anything like, because it hadn't been around for the last 40 years. It needs to come down. They said it was transitory. Now they're saying maybe not. This year, the Fed, who has given us so much free money, is walking a tightrope. It's difficult. And so what we're watching is not so much what the 10-year bond yield is doing, but what expectations are for the next 5 years. And the expectations of market participants are still that it's going to back off. Will it back off? This has a lot to do with supply constraints, which you also mentioned in your question. Supply constraints particularly have surfaced in goods, and we see a number of these areas coming off the boil. I, for one, believe that all those containers will be emptied, and by the end of the year, we'll have stocked shelves, and we're going to have a big sale, and I'm going to go ahead and go down to the shoe store and see if I can't find myself some, Jimmy Choo's on sale. I think that it will come down. We also have constraints on people, as you know. We need to get people back to work. And where that's concerned, you have a lot of people that have retired permanently, but you still have a lot of people out there who are living off of now $2 trillion in excess cash to spend. DC will be more important this year than in a long time. Markets love spending. We've seen very easy money out of DC. And of course, the Build Back Better plan, which would be more money spending, has stalled and dramatically. The market thinks it's dead. This time the market likes that though, because the market is worried about extra inflation that would bring. Finally, where DC is concerned, it's a midterm year, which would be very interesting and for volatility. It's generally historically a very volatile year. You'll get 10 to 30% corrections in such a year, but importantly, no matter what happens, you will generally have a good last month, several months after it is over. So I'll say finally, as I imagine my quick time is running out here, as we make our way through volatility this year, I think there are two keys to concern ourselves with. One is the Fed. Yes, they have to dial back all that easy money, but they are very anxious not to roil the markets. And so I think they'll be very transparent. I think they'll be slow. And I think we need to remember that the consumer still has $2 trillion of extra money that will power this economy. So we're bullish.
Thank you, Linda. So let's move into the equity market now. Jennifer, what do you think is opportunity in the US equity market? Do you see upside? Do you see the risk? What do you think is coming?
Yeah, thank you, Professor. Yeah, no, we are also bullish as well. I think, we coupled with volatility, as Linda had pointed out, I think, last year was kind of the start of the revenge of the old economy, and we continue to see that happening this year as the market transitions away from high growth stocks, technology stocks, as we've seen interest rates put pressure on the valuations of those companies, especially those without any earnings to them. We're seeing those come off sharply at the beginning of this year, and people rotating into value more so than they were even last year. So we've obviously seen a strong start to value-oriented sectors like energy and the financial sector. But we think that there's other parts of the market that were pretty, flat to down last year that present a lot of opportunity. And, we think that the market are selling out of those strong winners from last year and rotating into them. We think, people are looking past the Omicron virus, and, those consumers that have all that cash sitting there are going to start spending it on experiences and services and things that they have been, not been doing for the last couple of years because they've been stuck at home. So we're, very positive on the travel and entertainment industries. We like a number of stocks related to that. We also think that areas like medical devices, where people have not been able to get elective surgeries over the last couple of years, people still need their knees and hips replaced. And so we think that that business will recover very nicely over the next year, 2 years. And then finally, we think that the aerospace industry is really interesting. The largest aerospace manufacturer in the country, face its own troubles, but, add Omicron to it. But there's a number of airlines around the globe that need to replace planes. They're sitting on very old fleets. And a number of these manufacturers have backlogs of 4,000 to 5,000 planes that they need to produce and put out there. So we think that the aerospace industry will recover and generate great returns going forward. So we think there's a lot of opportunities. I think the final one that we saw that was really interesting to us was the payment space. There's a lot of activity in as people kind of rotated towards banks. There was concerns about potential, what happens with buy now, pay later, and how that affects like a PayPal or some of the other credit card companies. They were beaten up quite a bit last year. So we do think that there is an opportunity for recovery in those areas as well.
Good. Thank you, Jennifer. Robert, so now shifting about the global view. So, I mean, COVID and inflation are definitely kind of evolving globally. What are your views on the emerging markets?
So first off, thank you all for having me here. Thank you, John. Thank you, Professor. It's great to hear. It's great to hear my colleagues on this panel, my friends on this panel, I should say, their views. I think it rhymes with a lot of our views thus far from what I've heard. But we think it's helpful to frame our view on emerging markets by beginning with our view on where the relative value of the dollar is going. And the consensus view is that the dollar is going to strengthen because the Fed is the most hawkish of all the central banks, and therefore money will flow into the US to take advantage of a relatively high risk-free rate. And we actually believe that the rebound in world economic growth relative to the US will weaken the dollar because we think that the rebound in ex-US will be larger than expected. And the relatively higher growth ex-US will pull investment from the US and direct it into other faster growing regions. Our rationale for higher than expected growth in EM hinges on a few things. One, the virus. EM has much lower vaccination rates than developed market countries. And thus far, that's hurt their productivity. And with the pace that Omicron has raged across the globe, it's increased infections. And, you know, as you get and therefore immunizations in these regions could effectively inoculate larger parts of the EM population and lead to a production boom that we don't think is fully appreciated by the consensus. That said, we think it's going to be really, really volatile. And to the extent that EM has dollar-denominated net debt, any one of these countries, a weaker dollar allows them to pay back that debt at a lower cost. A weaker dollar would be helpful because all commodities are priced in dollars. And so a weak dollar allows EM countries whose fortunes are really tied to the performance of commodities to perform a little better. In addition, China is obviously a huge part of EM. And, you know, they went through a period where they were tightening and now they're easing policies to stem their economic decline and promote growth. And what's typically good for China is good for other emerging markets. Our thesis is also supported by higher growth, attractive valuation, and inherently lower duration equities. If you look at the equities in the US, the great tech and growth companies, they tend to be longer duration. As we all know, when you net present value those earnings back at a higher rate, it tends to have a greater impact. And we also suspect that in EM, supply chains pressures will ease, and EM will perform better as a result. The last point that I would make is there's certainly a margin of safety from a forward PE perspective. It's only 12 times in EM, slightly above the 25-year average, and at 21 plus times in the US, that's a 30% premium to the long-term average. So I think there's a lot of reasons why thinking outside the US kind of makes some sense, especially if you think this cyclical recovery is going to remain intact, which we do. Lastly, in prior tightening cycles, EM has done really well from a performance standpoint.
Interesting, very interesting. And now the fourth panelist is Michael. How are you advising your clients to invest right now, considering we have rising inflation, fiscal policy, and certainly Omicron still being around us?
Well, thanks, Professor, for having me, and thanks, John, for organizing the group. Good to be back. We're advising a couple of ways. In the first instance with COVID and the way we've seen Delta and then Omicron, where in stages we've opened up the economies, we're advising sort of a reopening trade over time, and that continues. Industrials, energy, the barrel price is up 65%, financials to a certain extent. So that's where we continue to look, but we also balance that by staying with the mega trends and the growth names. So sticking with technologies for the long term with high growth, and of course, sticking also with quality companies. Quality is a big factor for us right now. But the three trends we're staying with in spite of, or even in light of COVID, are digital transformation. So looking at areas like 5G, AI, automation, and automation is particularly important here, as you know, in Pittsburgh. Advanced manufacturing and robotics we're sort of the center of that here. So we're very excited that JP Morgan is interested in this and putting a lot of time and effort into it. Also with the cloud, cybersecurity is a very big area for us. The second mega trend we're following is healthcare innovation. Themes like personalized medicine, also artificial intelligence in diagnostics and therapeutics, and other healthcare, including virtual healthcare. So second dimension that we're maintaining our interest in. And the third is sustainability. So also the connections with Carnegie Mellon and with the Pittsburgh area in terms of clean energy, renewables, electric vehicles, autonomous vehicles, and that'll give rise to extended interest into semiconductors, which have the auto industry has suffered, and used car prices have skyrocketed as a result of not being able to get chips for cars. We agree with some of my friends and panelists that should unwind. Supply chain troubles should ease during the course of the year. And as that happens, perhaps into some more reopenings, such as travel, hospitality, and some of the international markets that are closing, but hopefully soon to open as hopefully we transition from pandemic to endemic. In fixed income, we've stayed short. We see the rising rates, so short duration, in some cases, extended credit. In addition to fixed income and equities, we're also looking to sort of hedge the interest rate rise and inflation with infrastructure investments, real estate investments, and in some cases, alternatives to expand the universe of opportunities in investing. So those are some of the themes and ideas that JP Morgan is advising.
Cool. Thank you, Michael. Yeah. Let me now come back to kind of monetary policy a little bit. So Linda, you've written about MMT, which stands for Modern Monetary Theory. How would you explain the current monetary policy kind of paradigm, and what do you think are the long-term implications for the US economy and the markets based on that new theory?
Yes, Lars, the modern monetary theory question, I just think is very, very fascinating and not very well discussed out there. But a lot of stars align to really make modern monetary theory become policy here in these last couple of years, starting with the fact that our populace has never been more politically divided, as we all know. But not only just the population, over in Congress, the divisions between the ideals, the ideological positions between the two parties in Congress have never been so polar opposite as what they are today. This was then fuel put on this fire with COVID, because with COVID, it provided an opportunity for big policy, which is what we have seen. Since COVID began in 2020, you saw the 40 of the top 50 ever in the United States weekly unemployment claims. 40 of the top 50 were just in 2020 alone. And of course, this hit mostly the lower income cohort, the services area. And what you saw was a 10% unemployment rate there, where for the rest of the higher income groups, a 5% unemployment rate. In other recessions, it was much closer than this. So there's a lot of talk about income inequality. And in terms of money, fiscal policy, monetary policy coming out there, but particularly fiscal policy to help the populace, it had this excuse with COVID. So if you looked back in 2007, when we had our global financial crisis, it was the first time ever that government debt was used in a big way outside of funding a war. And COVID provided the second opportunity. Not a bad thing. We closed our economy down. We were in a depression as we were around the globe. But the United States was outsized versus the rest of the world in our largesse, if you will. So if you looked again in history, the 5 largest stimulus packages that were ever proposed were enacted or proposed in 2020, where the debt that was promised in the name of COVID was $13,000 per capita. The next highest was Canada at $8,000. Meanwhile, China, with their draconian measures, were at 1,000. So today, the USA is at an unprecedented 110% debt to GDP that puts us 5th highest in the globe. And if Build Back Better were to come forth as was originally proposed, we would be catapulted to the 3rd highest debt per capita. This has implications for the economy and our growth long term. Raising taxes simply won't do enough to fight this. And when you have higher debt, history is very clear, it will reduce the growth of an economy. It can also hurt the value of your currency and bring us the persistent inflation, which we really don't want. So back in 2020, we were doing a lot of discussions about the election. There was a lot of talk about the election. Bernie Sanders was running and he was espousing modern monetary theory. And I thought we would all talk about it. We didn't. Bernie dropped out, as you know. But it is now policy, which is to say, the money machines are printing away. They continue to do so. Money showing up in people's bank accounts, like it's just unprecedented. And before I close out, what is modern monetary theory and what must you believe to think that it will work if indeed we carry on with this? The keys to modern monetary theory are permanently 0 interest rates. There's a job guarantee. Anyone who wants a job can go to the job office and he will get one if it's just digging a hole to refill it again. Unemployment in this environment is always a more important problem than inflation. What's it mean in practice? No longer do you need to sell government bonds. There is no independent Federal Reserve, and fiscal policy makes all the adjustments so that the government will be satisfied that all is well when the last person walks out of the job guarantee office. The trick in modern monetary policy is for our leaders to cut or raise taxes or spending just enough to keep our economy humming without persistent problematic inflation. The question for all, as you consider if we're in a permanent modern monetary policy situation, is, do you trust elected politicians with this task?
I definitely agree with you. So there's definitely kind of a risk coming from a high debt to kind of GDP ratio, or a high kind of debt per capita ratio. But at the same time, we're not Greece. I mean, so far we have kind of sound financial institutions. We have like judicial system. The democracy still works, and so there's still a difference to compare to, I think, a country with high debt per capita ratio and economies which are less stable overall, I would say, right, Linda?
Indeed, and I would just come back and say, certainly we're not Greece, we're not anywhere near Greece. Our dollar continues to strengthen, but a lot is being discussed and written about the Japanification of America. So one might check the history of Japan and the decades-long deflation they can't get themselves out of, and we wouldn't want to turn out as Japan, which itself is not falling into the ocean.
They're not. I agree. Yeah. Michael, what do you think? Like, will inflation kind of trigger a big recession in the upcoming year, or like will the Fed deliver kind of a soft landing this year, Michael?
Yeah, well, it could go one of two ways. And if we remember back to 1979, when Paul Volcker was stomping on inflation, they went way too far, raising rates from 10% to 20%. We don't expect anything like that this time. And we think indeed the Fed will, and the market, of course, will offer a soft landing. We think we're expecting 3 rate hikes in 2022, placing the Fed funds rate at around 1%. We think inflation, which is now 5%, as you pointed out, Professor, core, we think the inflation rate will come down to 3.1% in 2022 and 2.2% in 2023. So if our expectation is right, the Fed probably won't need to be too aggressive in tapering and hiking, and so we think that would provide a soft landing. On the other side, we have expected GDP growth, revenue and earnings growth. I think the panelists have mentioned strong balance sheets, not only in companies but also with people and families. So I think all of that and our expectation of growth and good performance in earnings with the companies that will overcome some of the tapering and hikes. On the other hand, if the Fed doesn't move slowly, and instead of hiking by 25 basis points per hike, if they jump to a 50 basis point hike, now they're signaling something different, and we'd be a bit concerned that they might remove accommodation too rapidly.
So you're expecting 25 bips or 50 bips in March? Because I mean, if you're aiming for 1% of all and they're doing 3 steps, there should be like a 50 bip step in there, right?
Well, we're hoping for and expecting 25, 25, 25. So yeah, and I'm using the 0 to 25 range for starters. So to your point, 75 to 100, Professor. But yes, 3 at 25 each.
Interesting. So given the new kind of monetary policy regime, Robert, and you mentioned kind of the duration argument before, do you see that there'll be like a big shift then from long duration to short duration companies, kind of from tech to growth, from tech to value, obviously? Or do you see like any other kind of big trends showing up in the equity market? So like, is kind of momentum coming back? I'm a big momentum fan. But momentum did pretty poorly last year. Kind of momentum is kind of meaning you're buying the winning companies, but last year momentum was doing subpar.
You know, I think you're going to be challenged for a little while there, Professor. I think in the short to intermediate term, yes, tech's long duration has premium valuations, and that's going to be a headwind for returns. I think it's going to be a durable headwind in the short run. Value offers lower correlation to interest rates. It's historically outperformed growth by 3% during past hiking cycles. But, you know, in the long run, I think you're going to be right. The long-term earnings power of tech, pricing power, recurring revenues, operating leverage, strong balance sheets is tough to ignore. But right now, given that we think inflation will be persistently higher, although not necessarily growing, it will lead to persistently higher rates. And that is going to be a headwind for especially high valuation tech stocks because of what you mentioned when you discount those cash flows back at an elevated rate, those distant cash flows at an elevated rate. And we do expect inflation to remain more elevated than consensus expects. And this is because we view there's been structural changes to the economy that are permanent, and they're permanent promoters of inflation. And that's one, the transition of supply chains from just in time to more resilient supply chains, moving away from that single point of failure supply necessarily requires increased cost. 2, an energy transition away from fossil fuels to cleaner energy. Although this evolution, or revolution rather, seems inevitable, it will be very cost and labor intensive to switch. And we've seen that this year with underinvestment in fossil fuel infrastructure. And there's going to be increased CapEx costs for solar, wind, and other renewable buildouts. 3, increased commodity prices. You know, natural gas is a central ingredient to ammonia, which is a primary ingredient to fertilizer, which is itself a primary input to agricultural operations. This chain leads to higher prices. And then finally, increased shelter costs, measured by owner's equivalent rent and rental rates themselves. It's a stickier type of inflation. So when you see rental rates increasing from the pandemic area where it was tenant-friendly policies and they roll off, increased home demand, which increases owner equivalent rents. All these measures increase inflation expectations. And when you have increased inflation expectations, you have entrenchment, right? And the Fed really wants to avoid, and I think they've said this very clearly, it's bizarre to me that the markets don't recognize that in Fed speak, they're behind the curve, and they're going to be tightening. And the impact on equities is going to be volatility. It's going to be a value rotation, at least in the short run, to value in cyclical pockets, performing better than the growth segments. But we still think if you're a factor-based investor, which you mentioned very early on in this, the best barbell is value in cyclical names, right? Married with high-quality growth names at a reasonable price. Those that can maintain their margins in pricing power. So we really think that, well, headline averages can be challenged, that selective stock picking makes sense. And these are the reasons why we're pivoting in to non-US, not just emerging market, but European markets. And that's where we see some of that more cyclical opportunity, and it's evidenced in price.
Mm-hmm. So lots of them have definitely supply chain problems. Do you think there'll be more production happening in the US? And a different question would be kind of like, for instance, is like Ford to you like a value or like a growth play? Because I mean, for all the companies that are shifting to EV, kind of Tesla obviously taking the lead. And whereas, I mean, isn't the line also getting a little bit blurry nowadays between value and growth?
I think so, but it's probably less blurry between the cyclical componentry of this, the aspects of this. I think you can have growth companies that are a little more cyclically oriented. I think you can have value companies that are a little cyclically oriented. But the fundamental central tenet that I like to steer away from when investing for the long term, and listen, there's been a lot of money made betting on the Pelotons, the DocuSigns, the Zooms. They're every day. They're in our lives every day. They are front and center, and they could be the next Amazons. Maybe not to that degree, but those type of companies that have persistently high multiples, and they eventually catch up. I think that's not going to be the environment that we're going to be in for quite some time. And so when I look at a Google that's an incredible cyclical beneficiary, right, just in the nature of their business, and their multiples not extremely high on a relative basis, I think that is the type of business that you can buy. I'm heavily attracted to Microsoft on these recent sell-offs that we've seen there, because sometimes the baby gets thrown out with the bathwater. And I run the firm now. I don't run our investment policy, but I'm charged with getting on and talking about it. And really, all these things are important in portfolio design. And the one thing you want to find yourself not doing is kind of going back to what worked, because Louis Bacon said this. Every now and then, something comes and knocks you into a different investment paradigm. And if you're not paying attention, you're going to get knocked off. Okay. And I think what's happened is we have QT and rates rising, and that is vastly different. It doesn't change the long-term secular theme of what these great growth companies are doing. But in the pivot point, you got to be paying attention.
I agree. The transition is definitely key here. Last question to the panelists, like Jennifer, like a big trend is ESG investing. So lots of people, they care about climate change and social issues, and seems to be kind of investors care more than politicians about ESG issues. So how do you think is ESG kind of affecting kind of markets? Like in what direction are we heading here?
Yeah, I mean, I think ESG has kind of taken off in the last couple of years, especially after the Paris Accord. It really kind of garnered a lot of global attention. And I think, when most of the countries signed on to that, plus you have a really radical shift, especially in Europe and China, moving towards electric vehicles, really focusing on climate change and renewable energy. It really kind of forced, a combination of investors, companies, and countries to kind of address all of these issues that have been coming about with climate change, and add on to that with all the social issues that are brewing globally. That it's all kind of come together. And so there's been a lot more focus. A lot of my clients are interested in ESG issues. And we've found that there's certain parts of the market that are become less investable now because companies, the companies that choose to ignore it. It's even interesting. You've seen the large integrated oil companies like an Exxon or Chevron say, we're becoming sustainable companies. We're moving away from fossil fuels. We're not spending on that energy space. You're seeing old line car companies, they're being forced to build electric vehicles like General Motors and Ford. Because countries like Sweden are, that any new car has to be electric, or in China, all new cars have to be electric. So that shift is forcing a lot of these old school companies to go into the renewable electric vehicle space. But there is this transition, energy production is down. It's about 10% below it was pre-pandemic levels, even though GDP has come back. And so, while we're transitioning to electric and renewables, you still need oil companies and energy companies to produce to match that those resource needs. So it's this interesting kind of transition that we're in, globally. But I do think that more and more companies are focused on it. A few years ago, only 50% of the companies produced sustainability reports in the S&P 500. Now it's well over 90%. We have companies calling us to engage on ESG issues. We actively, vote proxies around their annual meetings. So, very important issues for our clients. And I think that more and more people are trying to drive change with these companies and voicing their concerns around these various issues, which I think is great. It's really pushing the issues to the forefront.
Fantastic. Yeah, thank you. So let me now ask you a few questions which is coming from the audience. John sent me some questions. So first question would be, and that's a good one, should crypto be a part of a diversified portfolio? What do you think about crypto assets and Bitcoin? Should they be part of a diversified portfolio? Is that too new stuff for most people and too risky, I guess? And that's an open question for everybody now, please. Please
I'd like to jump in here on the crypto question, if I may. And because I've done a decent amount of work on it and trying to demystify, it's actually one of the most common questions that I get as I travel and talk to advisors or their end clients. Should I be investing in cryptocurrencies? And, I thought it was a joke when I first started studying it. And the more I study it, the more I realize that this is going to be with us and forever. And while there's not time to describe in detail what is so important about all this is that today, a quarter of the population of the world doesn't have a bank, but 65% of those people have a phone. And we are seeing in action the Bitcoin being the leader is being used as a means of payment to transfer for goods and services, peer-to-peer payment system. It is very secure. The blockchain on which it was built, and I think the Carnegie Mellon students will be very, very familiar with this. The blockchain is as revolutionary as the internet was back in the day. Is the digital ledger that is so very, very secure. It has never been hacked. It gets more and more difficult to hack. And the Ethereum network, which is the other major cryptocurrency, is based on smart contracts, which you will see proliferate all around the world throughout various industries. It is a digital gold here in the United States is Bitcoin. We could see that in 2020 when millennials and Gen Zs particularly were bidding up cryptocurrencies while the baby boomers say we're bidding up gold as we were worried about the money printing machines. And it is definitely here and to stay. 1 to 3% is about the average percentage of a portfolio that advisors have centered around as it's still going through its early days, and it is quite volatile, though a great diversifier.
I would like to comment on that as well. I think, we looked at crypto and blockchain very much in the same way that we looked at the internet in the late 90s. Frankly, none of us know where prices discovery is going to happen. We don't know who are the AOLs and who are ultimately going to be the Googles, right? And so you make bets based on who you think the blue chip players in the space are, whether that be a platform or whether that be one of the digital currencies like a Bitcoin. When I think about Bitcoin as an inflation hedge, it's just too tied to liquidity right now. It trades up and down as a risk asset, and I think it's too far away from being like gold as an inflation hedge. I would argue that gold's not even an inflation hedge and hasn't been for a long time. So I view Bitcoin as a risk asset. It is really focused on all these assets are really focused on the development of the blockchain and disruption in finance, where we've always had a godlike feature. that is the monitoring system. This is a trustless ecosystem. And so there's a lot of power there. And I think that you have to place a bet. Right now, we are placing somewhere between 4 and 6% of client portfolios in the ecosystem. We're doing it in a use case fashion. So we're not just trying to find the latest coin. We're basing our investments on use. And we think that's an effective way to kind of plant a seed in the space and bet on the entire ecosystem.
Mm-hmm. Makes sense, yeah. Another question from the audience. The housing sector has been significant appreciation as demand has outpaced supply for both new homes and rental properties. Well, what can you expect for 2022 for the housing market?
I can comment on that a little bit too. I mean, household formation has been lagging for quite some time. I think you have this millennial generation that's reaching the peak earning years of their lives, and many of them are getting married a little later, and so you're going to see household formation pick up. I think there's a shortage of housing supply in this country. So I think that demand remains persistent. I think you'd be foolish if you didn't think that price was sensitive at some point to rates. So at an absolute level, rates are still low, but the delta kind of may scare some people a little bit along the way. So I think fundamentally it's largely supported from a demographic perspective, and in an environment where we are consistently printing money, even though we're slowing that pace, we're consistently printing money. I think real estate is a lot of investors feel is an elegant hedge to that, because the rents can go up with inflation, at least to some degree.
I think if I could add, it's also a regional phenomenon. So people are now migrating from certain cities and states to typically the south and some of the high tax areas to some of the low tax areas. So I agree, supply has been depressed since the great financial crisis. I think we have to worry about that, the fact that we overshoot either way in any of these industries or sectors, but that's what happened. I agree with Rob. There's more demand now, and supply is a price killer in real estate.
Mm-hmm. Jenna, here's a question for you. What are some of your favorite companies in the sustainability space? And related, kind of, how do you measure sustainability? I mean, also in the ESG space, I always get confused because it's like Facebook, highly rated ESG company, but Facebook had all this kind of Wall Street Journal kind of outfall. So like, do you trust these ratings? Do they guide your decisions?
Yeah, no, I mean, we do our own research. So, I mean, the ratings for every firm are different. So I think you have to do your own work. That's, and inform your own opinions. I think what we really do try to focus on is high quality companies. I think, that's they tend to have more sustainable moats and more adherence to the UN sustainable goals than other firms. But we really do try to focus on the risks and opportunities for all of these companies and measure how they're improving upon different metrics. If that's diversity of their workforce, if that's data privacy, if that's reduction in carbon emissions. And then, some firms are just naturally tied to the ecosystem of sustainability. And, you think of electric car vehicles and solar, those are definitely tied to the sustainable energy industry. There's even components like the semiconductors and connectors and sensors that go into vehicles and devices that help with sustainability. So we're always looking kind of in different pockets where we can find companies that are focused on sustainability and doing a good job of engaging with their investor base and trying to make progress on that. So that's kind of key for us.
Mm-hmm. Thank you. Yeah. Another kind of esoteric question is about the art markets. I get lots of emails kind of fund companies that offer me to buy a slice on a Picasso. So is it worth kind of investing kind of in the fine art market? I guess like Rob, you're a collector. You have a Steelers helmet behind you. You have a Fender guitar on the wall. So is it worth kind of collecting unique items?
I think with the whole NFT craze, it feels like it's getting a little crazy. I do collect art, and I've had some success from rock and roll memorabilia to modern pop art, and I can tell you that I'm getting less interested at current prices. But I think a little bit of that is a demographic change, and not necessarily because of the because of the printing of money and such. So I'm not an expert at some of the classic art. I would describe myself as a pop art collector, but it's done phenomenally well.
Yeah, the art market is definitely booming, right? I mean, Picasso's, they easily go for 100 million. There was a Monet up for 100 million recently. Sotheby's. I mean, and I think, like, I mean, obviously, a few people have 100 million in cash, but I think there are fund companies out there where you can invest, let's say, 10,000, and then I get a slice of that piece of art, and the piece of art is then probably stored somewhere in Switzerland at an airport, and I just care about the price appreciation. So that's definitely also, I think, one of the more exotic ways to invest for the long term.
It's really interesting. All collectibles are booming, right? Whether there's classic cars that are up 300% over the last years, and it's this notion that cash is trash. I mean, we're just debasing our currency by 7% in the last year. Naturally, you're going to have a tailwind and a demand for hard assets of some sort. While I like collecting, I like productive hard assets though. So that's one of the reasons why we've been so invested in real estate, private REITs, and that's paid huge dividends for us over the last years.
Some of you bought some NFTs, non-fungible tokens. That's again a question about the crypto space. Is that something you invest for your clients in NFTs?
Is that a question for me? We don't
like Mike or someone. No, everybody.
I'll just say, not at the moment. We're looking at them. It's a very interesting study. You mentioned Picasso, what great masterpieces, and the demand for that kind of art and the numbers are skyrocketing. And so I haven't connected a Picasso to an NFT that I might create yet, but we're studying it.
Mm-hmm. Perfect. Yeah. Last question about the commodities markets. What do you see about what's going to happen with the oil and gas market? Is there any?
That's our favorite sector. We think that the price of oil is going to be north of easy, maybe even 110. So very bullish. It's our largest overweight.
Jennifer?
Yeah, I mean,
It's our largest.
Oh, sorry.
It's our largest overweight as well. Unfortunately, that's quite consensus. The good news is that it's still inexpensive. About, I'd say late November 2020, price to book was at a 90+ year low, at which time we at Federated Hermes were telling our clients, it's worth just taking a flyer for something that is historically inexpensive as what it is. But it is still for those who believe in the cyclical play, and we do as well.
We're in the same camp. We think price will appreciate, and it has a lot to do with supply as we shut down pipelines, don't approve pipelines, and if we rush the shift. Now everybody wants sustainability, but if you dig down to the next level, it's going to take some period of time to go fully sustainable. In the meantime, we have to look for clean energy. We still have to run certain things on hopefully cleaner hydrocarbon technology until such time as we can transition. We do an energy paper that talks about all this. But in the meantime, with the lack of CapEx and the supply, particularly here in the U.S., limited, we think the way for the price is up as well.
And then last question, how did attending Carnegie Mellon and the Tepper School impacted your career? Jennifer?
I think just being on the CMU campus with the diversity of thought and just an incredible community and and classmates, I've learned so much that I've applied, and I utilize my classmates all the time. I call on them, for industry expertise and obviously, self-serving, but it's exceptional professors that teach there. So I think, it was a great experience and it served me throughout my career.
Thank you. Yeah.
I'd like to chime in if I may,
Sure.
on at this one, because I remember back at orientation way back in the day when I was there may be 120 people as we were getting to know each other, and the organizer said 10 of you will drop out by Christmas, and they did do. They told us at that time, if you make your way through this program, which was exceedingly difficult and challenging for me, you will find your next job's comparative walk in the park. That sort of effort that they make you go through in terms of learning at Carnegie Mellon, in my opinion, it expands your work on thought processes, and it will stay with you throughout your entire career. So I'm blessed to have been there, to have been accepted there, really.
Yeah, great.
Professor, I've given a lot of thought to this. I just want to reflect for a second. It's leading edge. I was there when the late Dr. Laib was there. He was telling us in those days about electric vehicles and the trade-off between gasoline engines and power. And he explained to us, well, you have to make the power. And here we are all these years later, and that's what we're looking at. And Carnegie Mellon was talking about this stuff a long, long time ago. We got previews back then in artificial intelligence, and the whole world has continued to come in the direction of Carnegie Mellon, in the direction of Tepper. As I mentioned before, Pittsburgh being kind of the center of the universe for robotics and advanced manufacturing. I didn't even know what I was getting into when I went to school there on the first day, and every year and every decade it gets better. But it's just fascinating to me to get the preview a long time ago, and now we're living it. It's been wonderful.
Yeah, thank you, Michael. And Rob, last but not least.
I would tell you that if you can handle the workload at the Tepper School of Business, you can handle the workload anywhere. It is, I agree with Linda, it was a brutally difficult program, but when you sit in the front row, you really take advantage of your professors. There's a commitment to helping students make it. And I would argue that the 10 that dropped out were the ones that weren't as committed. And when I arrived for my first job at Morgan Stanley, moving from Pittsburgh to New York City, I felt so much more prepared than any of my colleagues that joined me there. And I would say that CMU played an important role in allowing me to get through some really challenging times professionally, just through work ethic. You had to work hard. And I will tell you that if you polled my finance and statistics teachers at Carnegie Mellon, they said that I owned the firm that I own today, their eyes would pop out of their head because I wouldn't be the one they would have picked. I promise you that.
That's good. Yeah, thank everybody for your time and for the insightful answers. Thank you.
Thanks for having us.
Thank you.
Yeah, I want to thank all of you for joining us today. It's been very inspiring to hear our alumni talking today. We had over 200 alumni on the call today. They have lots more questions, so hopefully they'll reach out and be part of the great Carnegie Mellon and Tepper alumni network that we have, and you'll continue to be successful in the year ahead. So thanks so much. We'll look forward to seeing if your predictions and things are right as we conclude 2022. Thanks so much.